Well, thank you, everyone, on a sunny day in March in Seattle for joining. I'll kick it off a little bit. A picture of myself when I had more hair, and just briefly, I had a sales career, Fortune 500. But I think what's really relevant is when I was a co-founder and a CEO of a startup, and then in my early days as an investor, I had opinions or impressions about buyers or why my company would sell or companies I would invest in, who would buy them that were a little bit naive. And I think a lot of people share that just because you don't have a lot of experience to companies that buy. I just thought I'd share some insights from the conversations that I have. A strategic buyer is, I would just call it, it's a real company. It's an operating company. They've got products, and they'll evaluate an acquisition primarily on how it fits with the acquiring company's strategic goals. And I'll talk more about that. And again, I focus on SaaS. Our particular niche, we focus on companies 5 million to 20 million in ARR. So that's the area that we know the best, but I'll talk about people in the whole spectrum. The largest SaaS companies by market cap, you've got Adobe, Salesforce, Shopify, Intuit, Zoom, ironically, thanks to COVID, Square, ServiceNow, Workday, Twilio, and Atlassian. A lot of these are household names, but I will tell you there are hundreds, perhaps thousands of large, vertically focused SaaS companies that are anywhere from 50 million in ARR to 300 million. And many, if not most of them, are companies that you've never heard of. I'm amazed how often we continue to uncover massive SaaS companies, and they're all acquisitive. So those are people that are putting money to work. So those are hired guns. They raise money. I'll go into more detail, and their goal is to get a return on their investment. So they're long-term investors interested in the return that they can get by buying a well-managed company. So there's private equity that we hear about, and there's a newer flavor of private equity that's focused on SaaS that is probably one of the fastest growing categories that I'll talk about. Very different than the traditional, buy a company / costs, to turn things around. There's search funds, their family offices, and their venture capital. So I created a slide to kind of talk through each one of these, and then talk a little bit about private equity because it's a big deal. It's involved in more areas than most people think. So, brief history lesson: Enron was a company that did some bad things. Sarbanes-Oxley was created. It's a federal law, comprehensive business financial practices that hold the CEO accountable. It's like go to prison things, and it's a good idea. The downside was it adds about $1 million, some say up to 2 million in costs. So small companies, if you're a $20 million company with 2 million in EBITDA, and you tack on 1 million or 2 million in costs, and all of a sudden you're not a profitable company, so you can't go public. So shortly after 2002, private equity really stepped in to fill the gap, to acquire companies that would have gone public. And they did really well, 40% IRR in some of the early days. And just to put that in perspective, in a 10-year fund, they turned 100 million into 1.6 billion. And when they turn around and look, where do we put the 1.6 billion? They plowed it back into more and more companies. So you've seen an absolute explosion in private equity. If you look at assets under management, you'll see they've got 4.5 trillion, which is a big number, and that's up from 1.5 million just in the last 10 years. So there's 3 trillion more in cash in private equity than there was 10 years ago. Just for perspective, that's larger than the GDP of India. It's only slightly smaller than the GDP of Germany. So there's a lot of money out there, and a lot of money that's looking for a home. And I'll break it down a little bit further. Basically, private equity has a 10-year cycle. They've got a sponsor. You'll see on top, Riverside is, I think, one of the better private equity companies that's out there. And they'll create funds. So you'll see they've got a European fund, they've got a micro cap, they've got Australia, capital appreciation, technology. And then in that fund, they'll go raise money from investors. That might be wealthy individuals, but it's often insurance companies, university endowments, and pension funds. So not that exciting, but they'll raise a big fund, and then they'll go out and they'll invest in companies. And private equity is very good at making money. So they'll charge the companies a fee They'll charge a management fee to the investors, so they make money on both sides, and they earn a percentage of the carry, so of the increased value that they produce. So it's pretty straightforward. They'll usually invest in the first 5 years, and then they might do some additions, and then they'll try to harvest towards the end because the investors want their money back. So often these are leveraged too. So they'll take the investors' money and they'll put 10 million in. They may raise 10 million in debt from the bank, and then the fees that the company actually pays the interest on the loan. So they're paying down the loan and they're paying the interest on it as well. So here's what gets interesting. A lot of the buyers that I see out there today, so you've got a private equity fund, and they'll create a thesis or a strategy. Typically, they'll go out to their investors with a thesis, and they may say, this is actually an actual one where they said, COVID is increasing our dependence on e-commerce. Small e-commerce companies are struggling to compete with Amazon. So software that helps these small players compete on logistics optimization, so basically reduce their cost of freight dramatically, is an area that they want to invest in. So that's actually a pretty hot space right now. They'll go out, they'll do an analysis. Guys like myself will bring them opportunities, and they'll look for a platform. And a platform is what they'll build around. Platforms almost universally have a minimum of 10 million in ARR. So if you want to be a platform and have that broad appeal, that's the target to get to. Often they can be 10, 20, 50, 100. Some of these bigger funds now, platforms can be 200-300 million in ARR. But here's where it gets interesting. The area that we play is they'll do add-ons. So they may have a platform, but part of their strategy is they're actively looking to add on 2, 3, 4, 5 companies to fill in gaps in the functionality and to add revenue. So there are a lot of very good companies out there that have, like I've got on here, 3 million, 5 million, 7 million in revenue. They're not quite at the platform phase. So they won't be bought directly by the private equity fund, but they're a great fit for these platforms as add-ons. I'll talk about it later. So you've now got something where the platform is a real company, right? So it looks like a strategic, but they've got private equity backing that has a big checkbook that's actively looking to add on. Most of the opportunities out there to exit for companies with, call it 10 million or less in revenue, are in these strategics because they're active buyers, and you can get the best and sometimes the worst of both, of being bought by a strategic and being bought by private equity. They call them add-ons, they call them tuck-ins, they call them bolt-ons. Why might they want to do that? So sometimes they're looking for geographic expansion. Sometimes they're looking for a product extension. Sometimes they're looking for additional products to sell into the same client base. So if you've got the same buyer, your existing team can easily sell to that same buyer. And I don't even mean the same company, but often it's the same buying influence within the company. Cross-selling, upselling is a big deal. You've got a client base, they've got a client base. The fact that they can sell the other person's products to each other's base, they'll build out a model for incremental revenue. It might be a competitor, and this is always it's a little bit sensitive because you're dancing with the devil, right? You're talking to someone that's a hated enemy that might buy you. On the one hand, you're sharing sensitive secrets to someone that you worry might copy them. But it is quite common that a competitor will buy you. So you may have a desirable customer base. For example, you may have a large government contract, and they may have struggled to get into the government, but they have products that they'd like to sell into the government. And then synergy cost, I think, is probably one of the more obvious. So if you've got redundant managers or salespeople or finance people in the background, those are instant cost savings. This slide I've got up just to show. A lot of people talk about we're going to get big and we're going to get bought by Microsoft, or we're going to go public. If you look on this chart, 2019, there 26 companies went public, 34 billion total market cap. Private equity bought 600 companies at 185 billion in market cap. So private equity as a generic group may not sound that exciting, but like I said, you got to realize these private equity funds still have money that they have to put to work, and every day, and they're all about IRR. So it's all time-based. So they want to put that money to work sooner than later. And anyone that's out there may see a huge influx of interest from private equity. There's a lot of money there, and there's a path for a smaller exit before you hit some of those big numbers. Okay, search funds. You'll see, I'll jump, there are 51 funds that were created. Again, this is 2019 data. Basically, this came out of Stanford, where they take an MBA graduate, some successful business people, think of it like super angels. So instead of writing $25,000 checks, they're writing $250,000 checks, and they actually buy the company, and then they operate it, and then they'll sell it 5 to 10 years later. These guys have done really, really well. Their median IRR is 32.6%, which is pretty remarkable. And they used to focus on more services business. Now there's a subset of these that I know, and I know the investors behind a lot of these that are actively looking to buy software companies, SaaS companies in particular. They like the recurring revenue model. Again, this isn't for everyone, but for some companies, this is a great fit. And these are two, General Pacific, Alta Lake Equity Partners. This MBA person is going to be the CEO. So if you want to stay on as a CEO, this is probably not a good fit. Family office. Many of you probably heard about family office. A couple in Seattle, Keeler. I think most people know. I think they're actually parts of them are involved in AOA. East Seattle Partners. That's Fraser, if you know Ignition. That's their family office. They're typically 100 million or more, and they buy companies. They tend to buy boring things like real estate, things that generate cash flow for the family. But more and more, they're getting involved with a subset of their money with technology companies. Their LPs are the family, which is often kind of nice. So it's like working in the family business. Graham is one of the larger ones. They're on the bottom. So their family office is 3 billion, and they're broken up into 6 different groups. One of them is all software. So family office is another sort of class of capital that can be a good owner and can potentially offer a second bite at the apple as well. So you may sell 60% of it to them, and then you continue to run it. A family office often wants you to stay on, but they want to buy 60%. They want a controlling interest. They'll inject some capital. They may sell it in 5 years, 10 years, 15 years, 20 years. It all depends. There's another class that I see proliferating. I call them buy and hold software companies. So Constellation is probably the best, most well known. They're value buyers. In some ways, they get a bit of a rap because they offer low multiples, but their market cap is 29 billion. They did almost 4 billion in revenue last year, so they've been very successful. There are some spinoffs of Constellation that are doing well. There are more and more, honestly, every month, because the model works, and many of them are willing to pay competitive multiples for better businesses. Strategic buyer, we talked about a little bit. So it's a company. They acquire another company, often the same industry, to capture synergies, leverage sales and marketing, reduce costs, add product functionality. Because they may buy you and you've got 100 customers, they may have 10,000 clients. They're going to roll your product out to their 10,000 clients. Even with a 10% adoption, your company goes from 100 to 1,000. So they don't just pay for what you have. They're often willing to pay more for what your company will be at their value. And much of what we help them do is build a model of sort of what that better together story would look like, both what the incremental revenue could look like, incremental profit. Because every CEO, maybe not every, most CEOs are struggling with the same problem. They're struggling with their organic growth numbers, and they're struggling to hit their profit growth as well. It's interesting. Sometimes people, and I saw this when I was on the buying side, where we looked at a company was for sale, they were a competitor. We were interested at 40 million, and through competition, it got bid up. And then it was less about our desire to buy them. And then it was about how much would we pay to make sure that our hated competitor didn't end up with them. And it was almost the fear of losing them to the competitor was more powerful. The company ended up selling for 110 million. So they created 70 million incremental value because of the competition. So often the fear, you say, well, this would be nice, but we don't have to have it. But then you think about waking up tomorrow with that as a part of your competitor, and you say, well, we don't want that to happen. Why do strategic buyers, what's their motivation, right? What about geographic expansion is one. I worked for a French company moved to Europe. They didn't have a strong footprint in the U.S. to be a strong tier one player. They needed that. So we went out and we ended up buying 2 companies in the U.S. that worked well. And that happens all the time. We talked to a company earlier this week that's based in the UK, looking at buying a U.S. company to get a U.S. Footprint. Product extension is super common, right? Especially with technology. It might be missing functionality. It might be to accelerate the roadmap, right? It's on the roadmap, but it's 2 years out, right? And there's never enough capacity to get things done. Or it might be a better solution. We've seen it before where they built the solution, but it's a crappy product, or clients don't like it, or there's just a lot of churn. And someone else really cracked the code, like it's really good, it's really sticky, and then they'll buy it to replace the other one. It's just more challenging, right? Because sales and marketing might want your product to roll it out, but the CTO is saying, "Hey, I can build that. We don't need to buy it." So sometimes your internal competing factions that make strategics will certainly can justify paying more. They don't always pay more, but they can also be trickier. Certainty to close can be lower because it's just more complicated, and they have a business to run and things can happen. They're not just in the business of buying companies. So the client base, buyer profile, the company can grow if your client base is the same as their client base, even if it's a different product. Entrepreneurs are often surprised that some of the potential buyers don't even do the same thing. Like they were never on the radar, but they've got the same client base. They've got 10,000 or 17,000 clients that your company would buy, even though you're currently not competing at all. And that's the cross-sell, upsell products to either side. Competitor, we kind of started with that. Desirable customer base, I talked about. You might have, you've got you're a vendor with Microsoft, and they want to be a vendor to Microsoft. Synergy costs, it's taken out cost. And I just threw a local example in there. A great example, Smartsheet, great company based in Bellevue. They bought 10,000 feet that had very specific, they'd cracked the code on some very specific resource management that was very difficult, both on the UX side. So they bought that and integrated that. It was a great fit for both sides. Some of the priorities, corp dev, I tell people often, someone will say, "Hey, these guys want to buy me." And I'll say, "That's great. Who are you talking to?" It's like, "Wow, this guy's, he's their partner sales guy." I was like, "Okay, that's not usually who can sign the check. Do they have corporate development? Is corp dev involved? Is the CEO involved?" Because ultimately, the deal's not going to get done unless it's a really large company. The CEO will get involved and have to represent it to their board. So you want to make sure you've got the right people that are involved. They're going to dig into the financials, particularly if they're publicly traded. All of them will probably do a quality of earnings check, and many of them will want audited financials, or they'll do an audit post-close, and then you'll be held accountable to any discrepancies that they find. Technology, if the tech stacks are completely different, sometimes people say we don't care, they'll run separately, and others it could kill the deal instantly. The CTO just says non-starter. We love the product, but we're not going to take on .NET or whatever it might be. The product, we talked about this a little bit. Often a competitor, which makes it delicate, and it can be touchy doing code reviews with a competitor, even though they're a likely buyer. It can just be very sensitive. But we've found creative ways that work for both sides. Customers, they'll typically go deep on your customers. We've even had a couple recently where the buyer wants to introduce the seller to their clients and do a joint demo under the guise of a partnership, which is a great way to pressure test it and find out, both from the buyer and the seller side, if this deal has legs, like if it really makes sense. So that, again, that can be a little bit tricky, but I think it's smart. Go-to-market strategy. They're going to want to know: do you do inbound? Do you do outbound? Are you really good product team and you're terrible at sales? That's actually okay, because that can then turn into a positive for them. They want to make it better, right? So if you've got a great product, the company's done well, and you're not great at sales and marketing, and they say, "Hey, you've done this well with our sales and marketing expertise, you can do really well." Pipeline, at some point they'll dig into the pipeline, they'll look at your forecast just to confirm that the pipeline matches the forecast. So these are things to be aware of before you sell, so you can think these things through. Make sure that the pipeline is clean, there's not just garbage in it. Make sure you've really done ideally some aggressive marketing before you get into the deal. So you've got a pipeline that does support your actual forecast. One of the things I see, it's growth and retention is what buyers want in SaaS companies. And that's my last slide. If you remember nothing else today, they like growth and they'll pay for it, and they like retention. Customers that stick, and not only they stick with you, but they buy more year after year. A lot of people don't give a lot of thought to what hits the logo churn number. So if everyone that's interested is signed up as a customer, it makes your churn numbers look higher. So people on trials or pilots, there are ways that you can not count them as customers. So if there's high churn on the front end, they don't hit your longer term churn numbers. So I talked about strategics and financials. And the reality is a large portion of the potential buyers for most companies are a bit of both. So this slide just shows if I went to Riverside, searched their portfolio, I could find companies like Arcos. If I looked at your company and did a search for strategic buyers, I would come up with a company, Arcos, and then I'd find out they've got a private equity sponsor in the background. And that's okay. In fact, it's good because the private equity has a big checkbook and they've got money they need to spend. So SaaS valuation, we try to look at our buyers, and we're pretty direct. Are you EBITDA buyers or are you ARR buyers? So some are focused on the EBITDA, so your ability to generate cash flow. And those are typically going to be lower valuations than from the ARR. That's not always the case, but it is almost always the case. And some reasons behind it, private equity, they're leveraged buyouts. They need to borrow cash. They can't borrow cash against a business that's losing money. Strategics, sometimes the strategic buyer, they don't want to pay 10x multiples of revenue because they're being valued on 7x multiples of their EBITDA. Kind of watch for that alignment. ARR buyers usually they've seen the light and they're pretty committed. They love the contractually recurring revenue, not having the uncertainty. And more PEs, I think literally every month are starting to see the value there. So they're migrating away from some of the traditional businesses. So that's the first kind of big category. Clearly you want to be valued. So it doesn't mean that EBITDA doesn't matter, but it means that you want to be valued on the revenue. So, all right, so here's kind of the heart of it, right? What drives the valuation? If you take the exact same profile of churn and growth, if you're at 1 million, there's a very small group of people that will buy the company. That it happens a lot, but it's tough. Once you hit 5 million, it's doable, particularly for smaller SaaS companies. 5 million might be accretive, so it makes a difference immediately to their total revenue. And you've got enough scale that it starts to become interesting. You remember earlier I talked about the platform size. You're not a platform. If you're above 10 million, there's probably an order of magnitude level of interest in buying the company than if you're below 10 million. It may feel artificial, or if there's a path to 10 million. But the multiples are higher. You see like Peakon being bought by Workday. You remember when Qualtrics was bought? Those were 20x multiples. And I see a lot of people say, hey, market's hot, I want the 20x. I'm like, well, you're 6 million in revenue. You're not going to get a 20x multiple. There aren't very many companies north of 100 million in revenue growing 40, 50% a year. And if you're in that category, you're going to get extremely high multiples. Over 10 million, the multiples are definitely higher than below 10 million. It's kind of the message there. Customer concentration. So let me go back to profitability. The company doesn't have to be profitable, but I hear some people that say profitability doesn't matter. It's all about growth. And I say, well, not really. If you're burning the equivalent of 100% of your revenue in a year, even if you're growing 100%, I can tell you a lot of potential buyers are going to be afraid of that just because you're burning. It requires so much money to keep that engine alive. If you're close to break even, if you're minus 10%, it's probably not that big of a deal. But I'm talking about companies that are like 50, 100% growth. If you're in a more typical 10, 20, 30, 40% growth, it'll be a lot easier to sell if you're at least break even. So break even does matter. So I hear a lot of people that and I used to say that, it doesn't matter, it's all about growth. Not really. There's no hard and fast number, but I can tell you if 70% of your revenue is with a single client, that's a big risk, and that's going to hurt your valuation. Their concern is if that contract doesn't renew, they just bought a company that's a third of the size that they thought they were buying. And they may put contingencies in place to protect themselves, but a broader customer base, anything 50% or more is certainly going to catch your attention. Ideally, no single client more than 10 or 20% is ideal. Logo churn tends to be higher with SMB, less with mid-market, even lower with enterprise. I'm going to talk more about that in a minute. Net revenue retention, I'm going to talk more about that. And then your target market. Do some good math on the target markets. You don't go down a path. Make sure you know what it is. You don't have to be experts on it, but they'll run a study. If it's strategics know the market because they live it. Private equity will have to learn it. I probably already spoke about this, but 100 million ARR, you're going to see big multiples. You will have no problem raising money or selling for a lot. Above 10 million, that's a tough place to get to, but it makes you very desirable. And again, it depends on some of the other fundamentals, but typically in this current market, 10x is not unreasonable. In that 5 million, and 5 million, I'll call it anywhere from 3 to 8. Call it in that. You've got proven product market fit. You've done the first level of scaling it. These are great add-ons for PE. It depends on how you value it. I call those, those can be 4 to 10x. The vast majority are probably 4 to 6. 5 to 6 is probably just to set expectations for people. You can certainly get more, but can have a whole nother talk. Structure often matters more than the number. So, if you're willing to accept risk, you can get higher valuations. If you want cash, that can bring it down a little bit. And then I say 2 million in AR and below. It's very different. It's got to be a very specific product fit because the revenue won't move the needle. Large companies often just won't even look at it. Companies below a certain size. So growth, these are kind of the categories I look at. You've got declining. I had a private equity guy tell me the other day, he said, we don't want to catch a falling knife. And I thought that was kind of graphic. But some will say they like distressed properties. My message on here, so we got declining, flat, sort of that 10 to 20%, which is quite common. Greater than 40%, those are more rare. Those are pretty hot. Then you've got the 100% plus, like those are the real hot shots. There are different segments of buyers for every one of these categories. So even declining is the hardest. If it's truly falling, it's going to be hard to sell for very much because they don't know where the bottom is. It really depends on why it's declining and if being acquired would stop the fall. But if the business is flat, if a lot of your metrics aren't great, there are value buyers out there. So there's a home for every category and honestly, almost every company. 10 to 20% I mentioned is pretty common. Those are good businesses. Greater than 40%. There's a rule of 40. Some of you may have heard about it. It's very real in private equity. The studies have shown that companies that have a growth rate plus an EBITDA percentage, those two combined of greater than 40%, statistically outperform those below it by a wide margin. So they'll pay a premium for those. And there's certain buyers willing to pay high multiples for those. And then, 100% plus, that's, like I say, growth. Although I'd love to sell a company that's that category, often I'll tell people in that category, like, why would you sell it now? You'll be worth twice as much or more in a year if you truly believe you can get there. And then the range of multiples is, from 1 to 20. And there are buyers that are happy. Well, they're buyers happy to pay 10 or more, and they're buyers happy to pay 1. So logo churn, I'll move quickly. I don't want this to be a lesson on logo churn, but it's a big deal. It's one of the metrics that they look at. 5 to 10% annuals is ideal. SMB is higher, enterprise is lower. It's really just the number of clients that churn in a cohort. If you start the year with 100, how many are still standing at the end of the year? If you've got 95, you've got 95% retention, you've got 5% churn. This pro tip I've got on the bottom right, I can't emphasize that enough. Set up your statistics so that people that are doing trials, that are just kicking the tires, that those logos don't hit your actual metrics. I know when I was running a company, I wanted every logo I had on there because it felt good. But when they're looking at buying your company, they'll run an analysis on all of those, and you don't want those to skew your rate higher. Net revenue retention is one of the biggest that I see. It's a measure of how well the clients that stay grow versus those that leave. Meaning if those that stay by more than the value of those that leave, it puts you over 100%. And if you're up 105, 110, 120%, that is extremely valuable. One of the biggest reasons I'll see, particularly private equity, but strategics look at it as well. If you've got a lot of churn, there's just concern about how sticky the product is. You got to remember, the reason people love SaaS is because it's sticky recurring revenue. If it's not sticky, it's not recurring. And so it hurts the valuation. This is just SaaS Capital had some metrics I thought were interesting. It kind of correlates overall growth rates for companies that over 120% tend to grow over twice as fast, almost 3 times as fast as those in the 80 to 90%. So one thing I throw out there, I do see a lot of companies that are hyper focused on sales and marketing, content creation, inbound, but they don't spend a lot of time on the client services side to focus on retention. And so that's where I encourage people, really focus on the retention early to make sure that you get it right. More data, I'll send this out. I'm not gonna go through it all now. This is KeyBank did a study of 200. It just showed what, if people wanna say, well, how do I compare? Here's some data that shows where you compare on the high end and low end. So total addressable market, I think we all know what that is. We talk about it, but I encourage people, do your homework, just find out, if you're selling to clinics, how many clinics are there of the size that would buy your product, and what's the value of each one of those, even as a crude number. What you don't want to do is find some number and say, hey, our market's $1 billion, and you spend a lot of time, and 2 months down the road, they do a market survey and they find out it's really only 100 million, and it falls apart. And you could have picked someone else that was in that market that already knew it, that didn't care. 100 million is small, doesn't mean they won't buy you, but it definitely makes it less attractive. $1 billion is large. Most people know that. The VC side runs through that as well. But what I found with like private equity is they'll run a study. They will hire an expert and run a study. They won't just Google some studies to see what's out there. Rule of 40, I talked about that earlier, growth percentage plus profit percentage. This is a recap, nothing new in here. And like I say, growth and retention, that bottom thing, is private equity, strategics, they're both good and they're often the same, and they all want growth and retention. So thank you for the questions, and we've got about 10 minutes for more questions.